If you're like many retirees or pre-retirees, you probably asked, how can I generate the income I need in retirement without running out of money? And what I want you to focus in on is what you can do so that you can gain the confidence you need so you can enjoy your retirement and have the peace of mind we all crave. Hi, I'm Annette Bau, host of the Wealth Inside and Out podcast and founder of the Millionaire Insider. My mission is to help you simplify the money game so you can create a financially secure and fulfilled life without having to have a PhD or spend countless hours on your finances. You're going to learn how to think like a millionaire, stop worrying about money and wondering if your financial house is truly in order, and instead spend your time doing what you love. With over 3 decades advising 7, 8, and even 9-figure millionaires, and now joining that elite group, I'm in a unique position to help you make the best financial choices so you can create a secure financial future and retirement you love. This is the Wealth Inside and Out podcast. Today's free resource is our residual income guide. You can go to themillionaireinsider.com/RIG. Residual income and passive income are possibly the two most important things when it comes to your overall retirement plan. This free resource provides you the step-by-step on different options and what you can do so that you can determine which plan would work best for you. So again, themillionaireinsider.com/RIG. For today's show notes, you can go to themillionaireinsider.com/121. MillionaireSeries.com copyrights all materials and intellectual property. This information is for educational purposes only. It is not intended to replace any advisor or specialist or to provide any investment, financial, tax, retirement planning, or healthcare advice. By accessing this content, you agree to hold MillionaireSeries.com and its affiliates harmless for results achieved or not achieved. So let's dive into total return and guaranteed income, a smarter strategy for a secure retirement. Today, I'm going to share some powerful insight to help you really stop just chasing high distribution rates, especially from closed-end funds that can lead to anxiety and even problems downstream if the overall return is not what it needs to be. I want you to not only focus on your total return that you're earning, but also in creating guaranteed income streams, such as Social Security, pensions, and annuities. And more importantly, what I want you to focus in on is what you can do so that you can gain the confidence you need so you can enjoy your retirement and have the peace of mind we all crave. So one of the things I want to dive into is why high distribution rates can be misleading. And it is amazing to me how many people go into retirement and their plan is focusing in on yields. And it can be so easy to get sucked into that. Whether the number is 6, 7, 8, 9, 10, 12, there are crazy numbers out there on distributions. The reality of it is oftentimes high yields can be masked in a really dangerous situation. Many of these funds are eroding their capital while handing you back your own money. So you got to be aware of that. You've got to have a plan on if you're getting money that is coming back as part of your return, which is the case generally with guaranteed income. You got to make sure you're planning for preservation of capital and principal in other areas. Some people call this destructive return of capital, especially when it comes to like dividend producing stocks or it comes to, say, closed-end mutual funds. What this term means is that your investment isn't actually growing, it's actually shrinking. And over time, it can lead to a falling net asset value, reduced income potential, and ultimately even less financial security. So you've got to pay attention to it. High distribution rates do not mean high return. So you got to understand that the distribution rate is not the same as total return. And a lot of people don't realize that until it's too late. So when it comes to total return, you've got to consider 2 factors. One is capital appreciation or loss. That's how the investment's price changes over time. And then you've got income distribution. This is from dividends or interest that are paid out. So the formula is total return equals the share price return plus the distribution rate. So for example, if a fund's price drops by 5% and it pays out 7% yield, your total return is 2%. Now, if the price drops 7% and it pays out a 7% yield, your total return is zero. If it drops by 9% and it pays out 7%, you've lost 2%. Your total return is a minus 2%. Now, one of the things you also have to understand is if that 7% payout includes part of your original investment. If it does, you're not making money. You're just getting your own money back. So you've got to really pay attention to that, especially on the side of your income where you want that to be around forever. So what is the alternative to this? Instead of chasing risky yields, I encourage you to consider a strategy rooted in more long-term security and peace of mind, which stems from combining guaranteed income with your total return. And there are two primary sources of guaranteed income. Now, there's also pensions, but because those are so rare now, we're going to focus mostly in on Social Security and then guaranteed lifetime income from annuities. So as far as Social Security goes, it offers a predictable, inflation-adjusted income that lasts as long as you live. That's currently. If you're paying attention to a lot of conversations, it looks like there's going to be a lot of changes. And one very likely change is to remove that inflation-adjusted income. Another one is to raise the retirement age. Another one is to lower the amount of money that people are getting. So like the maximum amount anyone could get is like $2,000 or $2,100. There are a lot of discussions going on, and they're very concerning considering the fact that only 22% of the United States is okay without Social Security. When you start looking at it, it is really terrifying for many people. One of the things that's really important when you are taking your Social Security is to really look at when is the best time to take it. I used to always say, wait until 70. But now with everything that's going on, what I recommend is you first of all look at your big picture. You have somebody that's qualified that can to make a determination because it may not be the best option to wait. Some of the articles I'm reading are just so concerning. And at some point, they're going to have to do something. If we're going to continue raising the deficit, which is just probably the most insane part of all the financial picture, something's got to give. They're talking about obviously cutting Medicaid. That's what passed the House. And Medicare continues to go up. I mean, the more you make, the more you pay. I mean, I know so many people who are paying over almost $1,000 a month or even more for their Medicare. There's just a lot of uncertainties as far as what is going to happen in the future. And so the reality of it is you've got to be paying attention and you've got to have a plan in the event that you don't have Social Security. But in the event that you do, even $2,000 a month, that number should continue to pay for the course of your life. Now, it's supposed to be bankrupt. It was 34, and then it was 32, and then it was 30. And so I just keep seeing different numbers, and I'm not sure anyone really knows. But the reality of it is something to pay attention to. And more importantly, if you're concerned about it, pay attention when you vote. The second topic is guaranteed lifetime annuities. And when they are structured correctly, annuities can replace your paycheck and create a reliable stream of income. They provide that confidence that you can't get in the market, meaning from like dividend stocks or even from real estate. Now, some annuities even come with long-term care riders or inflation protection. So you've got to look at your situation to determine what is the best option for you. Others are designed to accumulate income for 5 or 10 years and then start paying out. And again, you've got to look at the numbers, and it does change. Ideally, if you have some time to let that money accumulate before you start taking it out, it can be ideal. And you just want to make sure you're working with a fiduciary, so they have to offer you what's in your best interest versus what's in their or their company's best interest. So why guaranteed income works? With guaranteed income, you don't need to worry about market drops, share price fluctuations, or whether a closed-end fund is going to reduce its distribution, or even a stock. You know what's coming each month, and that allows many of us to sleep better at night, spend with confidence, not worrying that we're overspending, and then focus on doing what we want to do and not having to worry about what happened with our stock price. I've seen this shift literally change lives. Couples going from feeling so anxious and so worried about not having money or concerned about the years where the market doesn't perform and they have to take out less. And then all of a sudden they feel like they can't go on that family trip or they can't support their grandkids or even do the volunteer work they want to do. And they're very concerned about just basically essential expenses. So having guaranteed income cover your basic essentials, in my opinion, is the smartest financial move you can make. And then your other assets can either be invested in total return or in growth or a combination of the two. Now, even if you have guaranteed income, and some people are comfortable just having it with their needs, other people want it for their needs and wants. It all depends on your confidence in your plan and where you fall on that risk scale, meaning some people are just risk adverse. They're so risk adverse that it's concerning. But obviously, if you can't sleep at night because you're so worried about what's happening, then yeah, you'd be better off investing your money in guaranteed income. Now, the problem is keeping pace with inflation. So you've got to be aware of that. That's why I always encourage people, unless they have so much money coming in from guaranteed income, much more than they need, and that is always a top concern of mine. Now, in that case, total return can still play a bigger picture role. It can allow your investment portfolio to grow over time to keep pace with inflation. Even your growth-oriented assets. It can provide liquidity for emergencies as well as discretionary spending. Those are your wants. And it can help you be aligned with your overall risk tolerance and goals, knowing that you've got X amount of dollars in very safe assets. The key, though, is having that core income in something that is not risky and that you don't have to worry about it sustaining you for your life. And that's why I really encourage you to make sure you've at least got a portion of money coming in so you don't have to worry. And again, that can be guaranteed annuity, Social Security, or even pensions if you're lucky enough to have one. Now, I don't want you to get distracted from high yields because a lot of people are really not clear on different high yields, and not all high yields are bad, and not all closed-end funds are poorly managed. But if something looks too good to be true, it probably is. I can remember we had a foundation here, the Baptist Foundation, and I can remember I was really new in the business, and literally everyone is paying like, I don't know, 6 or 7%, and they're paying like 10 and 11%. And they did it year after year after year until they didn't. And they ended up filing bankruptcy. It turned out to be a Ponzi scheme. It was a disaster. And the problem is that everyone started getting sucked into them. People were making so much money, and then they're referring other people and their friends and their family. And it was just a disaster. But what you want to ask is this income sustainable? Is it reasonable based on what everyone else is doing? We had another situation with banks when savings and loans went under. And there was one bank that was literally paying 2 to 3 to 4 to 5 times more than anyone else. They ended up, same thing, went bankrupt. And, big issue and a lot of lawsuits, a lot of people going to jail. The issue was they were paying so much more than anyone else. That should have been the investor's first clue. The next thing you want to know is, are you depleting your principal? Now, with guaranteed income, depending on how you structure it, you likely are. But that's okay. That's the plan. The plan is not only do you want to deplete your principal, but then you hit a break point where the insurance company still pays you, and now you're getting free money. And that's why you've got to make sure you really clearly look at that and determine when you should start taking income to ensure you're not only going to get all your principal back, but more importantly, a lot more. And then you always have to look at any plan you have and make sure it fits in with your bigger financial picture, what you want to ultimately accomplish. If your strategy is leaving you uncertain or it's making you nervous, it's time to revisit that plan and make sure you have a solid plan so you don't have to worry. And the time to do it is before you have a problem. I see people who they've depleted assets, they have lost money, and they are now freaking out. That is not the ideal time to create the strategy. Do it before you have a problem. Some other considerations that are a little bit different, but I see these also impact your overall portfolio. And they're ones that I think you just want to entertain, even though it seems maybe some of them seem a little out there. Like the first one is getting really clear on what your goal is, and then setting the intention of achieving that goal, as well as elevating the emotion you feel once you have. Because the biggest issue I see with people who retire is the fact that if you have a lot of worry or a lot of fear, or a lot of anxiety, emotions below the grid, it's hard to break that. Ideally, you want to be elevating your emotions and getting above the grid so that you can feel peace of mind. You can feel flow. You can feel joy. You can feel gratitude. Because if you can get used to embodying that now, it's going to be so much easier once you get to the point of retirement or pre-retirement or wherever it is you want to be. And the key there is to be crystal clear as far as clarity of what you want, and then to be laser focused. The next issue is to assess your numbers. You've got to know, what are your expenses, your need-based expenses and your wants. Need-based expenses are rent, mortgage, taxes, insurance, utilities, food. Ideally, you have your house paid for. And if you don't, I encourage you to get it paid for before you retire. The next is want-based expenses. This includes travel, entertainment, dining out, things such as that. So that's really important that you separate the two. What I find commonly happens is that a person's like, oh, well, that's a need. Netflix is not a need, that's a want. Dining out is not a need, it's a want. Traveling is not a need, it's a want. You got to separate out, my friends. Food can even fall into that. I see people, I'm like, how much are you spending a month on food? Like, if you looked at my food bill, you'd say, okay, Annette, some of that's need, some of it's want. Spend a lot of money on food. So you got to be clear on that. And if you're following my advice and making sure that at least your need-based expenses are covered, you got to determine, do you want it to be all your food or just what you really have to have? And then if you set up your plan so that your guaranteed income only covers your need-based expenses, you've got to be willing to give up those want-based expenses if the market drops. And that may be some of those foods that you enjoy eating. So you got to be really clear on that. And then the third is to fund those buckets. And as I shared, need-based expenses should come from guaranteed income, Social Security, pensions, and guaranteed income annuities. And again, the exact type, it depends. Now, wants can come from variable income, dividend stocks, maybe even closed-end mutual funds that are paying dividends, bonds, real estate, and other non-guaranteed income. Now, one of the things I want to cover in here, a lot of people say, well, what about CDs or bonds where you're focusing in on yield to maturity? Those can work, but what you have to realize in those is that if you have a bond and your game plan is to hold it to yield to maturity and you end up selling it midterm, you could take a huge loss. With a CD, it could work. The only issue is the income you get from it is guaranteed. It's just that as inflation goes up and it doesn't keep pace with inflation, you have to keep taking more and more out, and ultimately it starts depleting the asset. So for that reason, I would say if you're going to use bonds from a yield to maturity or CDs, include those in your want-based income so that you've got the variable, even though it's not per se variable, it could be. And it could be either because it's lost value or it could be because you have to sell it midterm. I just want you to be aware of that because I really want those need-based expenses to be guaranteed. Like there's complete certainty. You don't have to worry about it. All right, let's look at some final thoughts on creating a total return portfolio. The first thing I really encourage you to do is work with a qualified person, somebody who knows what they're doing and can look at your situation. Because one thing we didn't cover in this, but that's so critical, is tax planning. A lot of people are going to pay so much more in taxes than they need to. Some thousands of dollars more, some tens of thousands, some even hundreds of thousands of dollars. So we've got to be really clear from a perspective of what we are paying and that we're not overpaying, because that is money that you're just going to be basically throwing away that you can't use. You've worked too hard to build your nest egg to see it chipped away, either from taxes or market volatility or even maybe misleading distribution rates. The goal isn't to chase yield, it's to create a financially secure life you love so you can do what you want and you don't have to be worrying about your money. By focusing in on a plan that combines guaranteed income along with total return and an alignment of where you're investing your money, support from the right advisor team, you can retire with confidence and live life in your terms and not worry that if you live past a certain age, you got a problem. I really encourage you to create a plan that's going to work for you so that you can make your reality come to fruition. The best time to start your plan is yesterday. The next best time is today. So instead of beating yourself up saying we should have done this 1, 5, 10, 20, 30 years ago, you just need to start where you are, do what you can, and consistently take action. And I just want to encourage you, my friends, you can do this. You've just got to take the steps to do it. Create the plan and implement it, and then continually show up and do what you need to do to make it a reality. You'll be so glad you did. All right, I want to thank you so much for joining me today. I'm Annette Ba'u. All international copyrights are reserved. If you love the content of this podcast, please follow and subscribe to our channel so you get notified of episodes, and also give us a 5-star review and share a comment. We really appreciate it. Congratulations on taking another step to create a financially free life you love. If you're not sure about your financial future or that it's in order, or you are ready to stop worrying about money, or possibly the fear of becoming a bag lady, ending up broke in retirement, or you simply are ready to know your financial house is in order so that you can have a bright financial future, please go to themillionaireinsider.com/NSF. And that doesn't stand for non-sufficient funds. It stands for Next Step Finance. It's the next best step of what you need to do so you can avoid an NSF notice in your future. Again, themillionaireinsider.com/NSF. The number of women who were not broke or poor while working or married is staggering. The entire mission of the Wealth Inside and Out podcast is to ensure you have the information for you, your family, your friends, anyone who's willing to listen to it and apply it so that you can create a financially free life you love. Again, themillionaireinsider.com/NSF. Until our next episode, take one action that will help you create a financially free life you love. I'm Annette Ba'u, your host. All international copyrights are reserved. Bye for now.